Michael, I'll start with you. I want to get your response to the numbers we saw this morning and what that actually means for the market, which seems to be, at least right now, pre-market, responding from an equity standpoint pretty favorably.
Well, bad news is good news. My concern was we're going to have some blowout number, and then there's going to be big concern about inflation, the Federal Reserve. The fact that things are coming back more gradually, I think, is a positive for the economy. I think that's why you're seeing the market bounce based on this news. And in my view, also gives additional support for the need for another stimulus package and an infrastructure bill that they're working on right now in Washington. So I think it's all in all, while it may be the headline of a disappointing report versus expectations, I think it's actually a pretty good report in terms of the market, because it appears as if these numbers support that we are having a reopening, but we're not going to perhaps have the screaming inflation that many are concerned about.
Yeah, I want to dig into that stimulus piece of the conversation a little bit more, especially given the fact that we do know there are ongoing infrastructure talks today coming out of the White House as well. But first, David, I want to get your thoughts on the numbers this morning, since I know you were forecasting a much stronger number in terms of jobs added for the month of May.
Well, that's right. And I think what this report really says is we've got a labor supply problem. I think it's a temporary one. But to me, the number that jumped out of this report is that the labor force actually fell by 53,000. Now, normally when you've got a recovering economy, when you're coming out of a pandemic, you would expect to see the labor force rise. So what's happening, I think, is a lot of people, because of lingering pandemic concerns, perhaps, but also because of unemployment benefits, aren't coming back into the labor market. And that is causing wages to go up. I mean, what we look at is actually year over the last 2 years. So we try and take out the extraordinary distortions from a year ago. But over the last 2 years, the average hourly earnings of all workers have gone up by 8.8%. So that's 4.4% annualized. And that's about the strongest we've seen at any time, certainly in the last 15 years. So we are seeing strong wage growth. And I think that is more that'll stick. So I think even as some of these distortions in the labour market ease over the rest of this year, the fact that businesses now have to pay up for labour, I think that will feed through to somewhat higher permanent inflation, not just the transitory inflation that the Federal Reserve talks about so much.
Michael, I wanted to get you on a couple different things. One is those who have been unemployed for 27 weeks or more, we are actually starting to see some good improvement. I wonder what you think that means for the longer term. And then this optimistic notion that people have the option now to be a little bit more choosy about the job they take. Some believe that means less job churn down the road, better job matching, which is, in the end, an efficiency for the economy. You go along with that?
I think that's just noise at this point. I think it's really just a transition off of unemployment benefits as the economy still reopens. Here in California, there's still lots of debate whether or not you should have masks or not masks, and certainly employers are watching that information very carefully regarding the regulations. Cal OSHA, for example, really is very torn whether, even if you're vaccinated, whether you should wear a mask indoors or not indoors. So in the United States, certainly there is a wider opening, I think, that is leading towards people reentering the workforce. In California, which obviously a very populous state, there's still a lot of concern and a lot of confusion about what this is going to mean. So I think for employees, particularly those who are very nervous about the COVID situation, they're just really, really uncertain. Apple, for example, announced they're going to have people back in the office 3 days a week. And I know that's created some concern for employees of Apple. So it's really hard to say. I think David's very much correct. There's a lot of sort of anomalies and churn that's happening right now, but I think long term, the trend is moving up. Wage growth looks pretty good. And I think eventually we're going to recapture many of the jobs that were lost during the pandemic.
So, David, what does that mean in terms of where investors should be putting their money to work right now, especially as we see something of a middling movement for the broader market, but then you do have these pockets of fervent trading, for example, AMC, which we've been talking about all week?
Yeah, I think people should try not to look at some of these meme stocks and all the distractions here. The message that I think people are missing here is that inflation is building. And there is no excuse for the 10-year Treasury yield to be at 160 today. We've got oil at $70 a barrel. We've got all these pressures where businesses are having to pay up for labor. And I actually like to see businesses having to pay up for labor, but that is inflationary. And I think what that suggests is that by the end of the year, long-term interest rates will be a good deal higher, and that also helps value over growth. Probably, I'd still be in favor of international over domestic, and be very careful about high PE stocks. Be careful about valuations, because you can have any old valuation when interest rates are zero, but when interest rates get pushed up, that's when valuations really count.
Michael, I'll put the same question to you.
Yeah, I think I'm a little less optimistic about international. I still think the U.S. More established economies are probably the place to be, in my view. And I do believe that valuations are going to be a huge deal. I mean, we have, as you mentioned, the meme stocks. These are more mechanical issues happening in the market regarding short sellers. But I think that having value in your portfolio is going to make sense. I think you're going to want to have income-oriented assets that maybe are not so impacted by interest rates when inflation does tick higher. So I think the market is set up right now for opportunities for investors as long as you're watching valuations, because valuations will matter. That's why tech has gone down when inflation fears are high. And so investors can't be complacent and not look at valuation, because it is going to matter in the portfolio. It will eventually. It just takes time.
Shepard Smith here. Thanks for watching CNBC on YouTube.